Good morning, everybody. Welcome to the Money Show and the 5 ETFs for the long term. The speaker is in the room. We are on time for an 11:15 start, about a minute and a half from now. So just stay with us, and thank you again for joining us. We'll be right back to you.
Okay, Joe.
Good morning, everybody. Welcome to the session. We're going to be starting in about a minute's time. The speaker is in the room. We are ready for an on-time start. We'll be back to you in less than a minute. Thank you. Hello and good morning, everybody. Welcome to the session. My name is Joe Fitzgerald. I am with MoneyShow and I am your host this morning. Thank you all for being with us. Jerry Robinson is in the room. We're going to start shortly. Just a couple of bits of housekeeping, and I'm going to hand off to Jerry. This session is entitled 5 ETFs for the long term. 2 bits of housekeeping. First of all, thank you all for your feedback, comments, and suggestions. We love it here at Money Show. It makes us better. So again, thanks to all the speakers and participants, and of course the attendees. It's you guys that make us better and better as we do these things more and more. So, and we're getting great feedback. Secondly, we will take some questions and answers at the end of Jerry's session, time permitting. So there is a chat box on your desktop. Please put those questions in there. And again, time permitting, we're going to get to as many as we can. With that said, I would like to introduce to you Jerry Robinson, who is a trend trader and a trading coach. Jerry is the founder of followthemoney.com. He is an economist, a veteran trend trader, a best-selling author, and a trading coach. Jerry's trading specialties include the 3 times ETFs, deep in the money call options, and growth stocks. He is the best-selling author of Bankruptcy of Our Nation. It is with a great pleasure that I introduce to you Jerry Robinson. Jerry, the floor is yours, sir.
Thank you, Joe. I want to thank you so much. And thank you so much for being here today, friends. Thanks for taking time to join us here at the ETF Investing Expo. This is going to be a great time today, as you probably already know. Before I get started, I want to give a quick shout out to all of our Follow the Money members who might be in the audience. Thanks for coming today. And also a big thanks to Joe, Rena, and Debbie from Money Show, who just work tirelessly, and all the Money Show team who make these events so successful and helpful and educational for you. So let's begin with today's presentation, 5 ETFs for long-term growth. We're going to talk about what's ahead. So before we get started, I want to remind you that I am not an investment advisor. I'm not a financial advisor. I'm an individual investor and trader like you. Now, all the things that I'll be sharing today are shared for educational and informational purposes only, and I urge you to reach out to a trusted investment professional before you make any investment decisions. Now, one of the very best definitions I've ever heard of investing came from a book called The Battle for Investment Survival, written by Gerald Loeb, one of the best investors of the last century. In fact, he played a major role in shaping and forming William J. O'Neill, who was the founder of Investors Business Daily. If you haven't read this book, I encourage you to pick it up. It's fairly cheap. You can find it on Amazon. But on the very first page, Gerald Loeb gives, I think, what is probably the very best definition of investing that I've ever heard. And here's what it is: storing present purchasing power for use in the future. Makes total sense, doesn't it? In other words, we have to do something with the money that we are stewarding, the money that we have in our possession. We have to do something with it. We can, of course, put it into a glass jar and put it in the backyard, dig a hole, and maybe come back and find it later. But what we'll find is that that money is perishable. And if we don't actively invest that money, then it's possible that we're going to get behind because of inflation and taxes and all of the different eroding factors on money. So storing present purchasing power for use in the future is wise. And that's what we call investing. So putting your money to work is really what investing is all about. Now, you have several options when it comes to long-term investing. You can focus upon cash, right? You could just put, as we said, you could put money into a glass jar and hide it away, but that's probably not going to be a very wise idea over time. You could use bonds to grow your purchasing power. Real estate is certainly a wonderful place. Commodities, many people like to use commodities for that purpose. Art and collectibles, that's a niche area. Gold and even other precious metals, that's certainly another area that many people consider. But today we're going to be focusing upon common stocks, specifically those basket of stocks known as exchange traded funds, or ETFs. And so what we want to do today is talk about 5 of these ETFs, these exchange traded funds that are like mutual funds, but they actually trade like stocks. And I'm sure most of you are familiar with ETFs since you're at an ETF investing expo. So let's talk about number 1. The very first ETF that I have here, and there's several. Of course, we have 5 today, and the very first one may be the most expected. It is SPY, the Spider S&P 500 Index ETF. So SPY, for many people, this may seem a little too obvious, and in fact, Warren Buffett, if you're familiar with the work of Warren Buffett or you've ever heard him speak at his annual investor presentations that he does, he has actually stated that when he passes, the majority of his money is going to be placed into into SPY or something like it, an S&P 500 fund. That is, when we think about beating the market, somebody says, I'm going to try to beat the market. Well, what they really mean is they're trying to beat the S&P 500. It's been said over and over again that 3 out of 4 money managers and mutual funds and other funds fail to beat their benchmark, typically the S&P 500. And that's really quite staggering when you think about it. So if you want market returns, then the S&P 500 will provide those. In fact, you can enjoy diversified exposure to the United States stock market without taking on that single stock risk. So you automatically own many, hundreds and hundreds, of course, nearly 500 stocks that are all in one single basket. And when we look at the top 10 holdings of SPY, we see high quality companies like Apple, Microsoft, Amazon, Facebook, and many others. And so as we look here at SPY's performance over time, we'll see that year to date, we have a year-to-date return of about 12.5% as of this print. When we go back to the inception of SPY, all the way back to January of 1993, we see about a 10% return year-to-date, or annualized return, we should say. So about 10.3% since inception. Over the last 10 years, it's been better, but about 14%. And when we look over the last 10 years, again, we see that a $10,000 investment in SPY would have turned into about almost $40,000. And so again, when we think about taking that present purchasing power that we have and putting it to work somewhere, investing, well, we certainly see that SPY can provide a fairly decent return. And again, without that single stock risk. So averaging about 14% over the last 10 years. The expense ratio on SPY is very negligible. It's around 0.01%. So we're talking about 0.1%. So you're not too worried there about the expense. And when you look at the current dividend, it pays about 1.33%. So it seems to be a pretty ideal place if you want exposure to the market, but you don't want to take on that single stock risk, nor do you want to even take on a thematic sector, maybe focusing in on a theme. Now, we will have another idea in a few moments about a themed sector that we'll focus upon. But for SPY, this is for very general investing. And when we look at when we think about SPY, I want to show you one cool strategy that you can use if you like to trade around your investments. And this is something I call the ROI boosting investing strategy. And what I mean by this is that if you like to trade, this is something that I've been doing for many years, and I have found it to be so powerful. So I personally invest in ETFs for the long term. So my personal long-term retirement portfolio is composed of many different ETFs. But what I like to do is, because I know how to trade, I like to take that particular ETF and trade around that long-term core holding that I have. So since I'm going to own a particular ETF, then I may want to trade around it. And so the way this would work is that you would own shares of SPY as a long-term investment, but then you would trade around your core long-term holding to boost your annual ROI. So instead of waking up every morning and saying, what stock am I going to trade if you're a trader? You could say, I already know SPY. I've already invested in SPY. And so since I'm comfortable with this particular investment, what I'll do is I'll trade around my long-term core holding. So you have several different trading tools available to you. You have call and put options. So if you buy the S&P 500 ETF, then you can trade a call option or a put option so as to amplify your overall gains. Or you can use leveraged ETFs. So for example, if you wanted to go long the S&P 500 and earn a leveraged return, you could use something like SPXL, which gives you a 3x return. Therefore, if you see that the S&P 500, for example, is entering a new uptrend, maybe it's broken out above its 200-day moving average, or maybe it's doing something bullish on the chart that you think is going to deliver a nice near-term gain, well, then what you can do is you can boost your overall annual ROI by placing a short-term trade using one of these leveraged ETFs so that you're able to capture more upside from that particular rally in your underlying investment. And so this is what I do personally with several of my holdings. And another thing you can do is you could, instead of using a leveraged ETF or a call option, you could just simply take a look at what are the top 10 holdings of SPY, and you could use one of those and trade one of those, since that's already in your wheelhouse. You know, an example here would be to your long-term SPY investment earns 10% in year one, and your trades earn another 15% for the year. So you end up boosting your annual ROI on SPY, and you never really had to leave that area. You didn't have to go learn something brand new. You just stayed right in your wheelhouse. You like SPY for the long term, and then you trade around SPY to boost the overall annual return. It's a really cool strategy that we call the ROI boosting strategy. So the second ETF that we want to talk about, and this is actually one that I own in my long-term retirement portfolio myself, is QQQ. This is the Invesco NASDAQ 100 ETF. It gives you access to the NASDAQ's 100 largest non-financial companies in a single ticker. And many of these are the most innovative companies in the world. So you instantly own, with this particular ticker, America's leading tech firms in a single ticker. It's the second most traded ETF in the US based on average daily volume traded. That was as of last year, but that seems to still be the case. When we look at the top 10 holdings of QQQ, you see some really big names: Apple, Microsoft, Amazon, Facebook, Tesla, Alphabet, NVIDIA, PayPal, and Adobe. These are all juggernauts and major, major innovators. What's nice is that, again, you're able to, with one ticker, get exposure to all of these major innovative companies, and you're really focused upon the top 100. Now, why I like the NASDAQ 100 so much is because instead of investing in every single company in the NASDAQ composite, what you're really focused upon is that top 100, the top 100 largest non-financial companies. And you know, that is always changing. So Tesla was, you may recall, recently added. Many other companies were recently added. Some companies are kicked out. And so this allows, this allows the 100 index to really grow and change with the times. The performance on the QQQ has really been pretty decent. Since inception, it's a little better than the S&P 500. You earn about 13.8% annualized since inception. Over the last 10 years, though, however, it's provided a 20% return annualized. And so that's a really, really decent return. So you can see that a $10,000 investment in QQQ 10 years ago with dividends reinvested has turned into nearly $70,000. And again, that's without the single stock risk, which is so powerful and why I like ETFs so much. The expense ratio on QQQ as well is very negligible. It's 0.15%. And it pays also a fairly small dividend of 0.52%, as most of these companies are in growth mode. And again, when it comes to available trading tools, you have QQQ call options and put options. You have leveraged ETFs. I personally like to use TQQQ. This is a 3X QQQ. And that means that for every time that QQQ goes up 1%, well, TQQQ is designed to go up by 3%. I've talked about 3X ETFs at MoneyShow many times in the past, and these are very powerful tools. Now, you don't want to use them until you fully understand them, but they can be very powerful for souping up your overall returns in the market. And then if I feel that the market is getting ready to go down, or if I see that the NASDAQ 100 is entering a downtrend of some kind, a material downtrend, well, then I can use a short ETF to hedge. So SQQQ, I would make 3% every time the NASDAQ went down 1%. So I can do all of this with ETFs without ever having to move into options or futures contracts or anything like that. So it's very powerful. But again, you really want to educate yourself on that topic. And again, or you could also trade one of the top 10 holdings from QQQ as a way to boost your ROI and trade around that core holding. There's a couple of comments here I want to make before we move on to the next ETF, and that is that Invesco has released some new ETFs around QQQ. One that's somewhat interesting is QQQJ, and this one carries a similarly small expense ratio, but it's called the Invesco NASDAQ Next Generation 100 ETF, and this provides exposure to the second 100 top companies. So instead of the first 100 where you have in QQQ, this goes to basically the next 100. So 101 through 200. These are companies that may eventually make it into the top 100, but they're currently not there yet. So this could be an interesting strategy. This is a new ETF that came out last October. And so we'll just kind of keep an eye on it and see how it does. But I think this might be a pretty good idea for long-term growth. Okay, the third ETF I want to talk about today, and we're moving through these quickly for the sake of time, also leaving time for your questions, is KWEB, Crane Shares China Internet ETF. Now, this particular ETF I own as well, and I like this ETF because what it does is it provides exposure to China's growing middle class via internet companies. And if you've been paying attention to the space in China for some time, you know that recently, especially since late last year, China has been really cracking down on tech firms. It really is moving in a pretty draconian way. And this has caused some of these high-flying tech companies that for many years didn't seem to have as much accountability as some people wanted, now have been really beaten down. Some of these top names like Baidu and JD.com and Tencent, many of these companies have been beat down from their prior highs, which may be attractive to a long-term investor. And so KWEB, again, gives you exposure to these internet companies in China that really have done very well over the last many, many years. If you look at the top 10 holdings, you have companies like we mentioned, Tencent at the very top there, Alibaba. Both of these have been pretty hard hit from the regulations in China. Also, Pinduoduo, JD.com, Bilibili, Baidu, KE Holdings, NetEase. These are all very popular companies in China, and you get access to these companies in a single ticker, which is, again, taking away that single stock risk. When we look at the overall returns, we see that while we've had a good one-year return, 33%, the three-year return is a little less. If we look at since inception, it's about 15%. So it's actually done very well, 15% per year. Who can complain about that? KWEB actually became available back in 2013. So this isn't really a full 10 years of data, but since inception, that's still a very good return. You can see since 2013, when it became available, $10,000 has grown into nearly $30,000. The expense ratio on KWEB is about 0.73%. So it's a little higher than some of the other ETFs we've talked about. It pays a small dividend of about 0.32%. And again, when it comes to trading around or using the ROI boosting strategy on this particular ETF, you could certainly do call and put options on KWEB if you wanted to amplify your returns. You could also use a leveraged ETF, CWEB, which actually provides 2x leverage on Chinese internet companies. Or you could, again, choose a top 10 holding from KWEB and target that one for your trading. My fourth ETF is a little generic in the fact that really it's anything by Cathie Wood. So Cathie Wood, many of you probably know, is the founder of ARK funds. And ARK Invest in their funds have really made some bold bets on very innovative companies. And I didn't really want to give you just one. I just wanted to expose you to all of them. And I would assume most of you are familiar by now with Cathie Wood and ARK's active ETFs. Here's a list of the different ETFs that are offered. But if you're not familiar with ARK, I would encourage you to check them out. They have a very interesting and I would say a compelling strategy for long-term growth in the innovation space. So as you can see here on the screen, there's 1, 2, 3, 4, 5, 6 different ETFs that are covered. ARKK is probably the most well-known. It's the ARK Innovation ETF. Innovation is just going to be here, right? We are going to constantly have innovation in many different spaces. ARKQ, for example, focuses upon autonomous technology and robotics. ARKW focuses upon next generation internet. ARKG is a very interesting ETF as it focuses upon genomics and the genomic revolution, so the CRISPR technology and things of this nature. ARKF focuses upon fintech innovation, which that's a burgeoning space. And then also there's ARKX. This is one of the newer funds that focuses upon space exploration and innovation. So you can see these are very thematic type of ETFs that give you exposure to unique spaces that you may have to take on single stock risk to get exposure to these, but now through these types of ETFs, you can gain exposure to a basket of stocks in this space, which can lower your overall potential risk, but at the same time, still give you exposure to many of these innovative companies. So again, I would encourage you to check out ARK's active ETFs. We actually here at Follow the Money, we keep track of of Cathie Wood's entire portfolio and rank them by our proprietary smart score. And it's just pretty incredible, some of the stocks that she has found and uncovered. So we're pretty impressed. I should also mention ARK Invest is also focused upon a new Bitcoin ETF, working with 21 shares. That ticker was going to be ARKB, but that, of course, is going to require SEC approval, and who knows when that will happen. My final ETF today is a unique ETF, and so far, it's not been very profitable. But it's a new ETF, and it's called YOLO, YOLO, and it's the Advisor Shares Pure Cannabis ETF. So this is the very first active ETF with dedicated cannabis exposure, and it became the first actively managed ETF available in the U.S. And it's pretty interesting because it's an active ETF rather than a passive strategy. So it allows the fund managers to respond quickly to this rapidly evolving cannabis marketplace. And if you're not familiar with many of the different cannabis stocks, then but you still want exposure to the space, an ETF like this can be, worth considering, because again, it's going to give you exposure to this clearly burgeoning space without having to know exactly which stock you think is going to win the horse race, so to speak. Who knows what brands will ultimately win out in the future? If you look at a map of cannabis legalization by state, you'll see that it's just growing, and the laws are changing at a rapid pace across all 50 states. 19 states now allow for recreational cannabis. And more than 40 states already allow for some combination of medical, or they decriminalized, or it's completely legal. So you really only have 1, 2, 3, 4, 5 states, about 5, maybe 5 or 6 states where cannabis is fully illegal still, the way that it is at the federal level. So we're certain, but at the same time, what makes this a compelling, industry, I think, for some investors, is the fact that institutions have not really been able to pour money into this space yet because of the federal regulations. And so eventually we will see, of course, I believe that the federal government's going to have to do something about this. And when they do, we will see an influx of institutional investors coming into the space. And so those investors who are in early and in high quality companies that may attract investor capital from the institutions, that could be a boon to them. So YOLO owns, basically you own leading global cannabis stocks in a single ticker. When we take a look at the top 10 holdings, we have some really well-known ones. Village Farms, the REIT IIPR, which has been very, very successful. Grow Generation, which has also been a big winner. Green Thumb, Tilray, Canopy Growth, Curaleaf, Cresco Labs, TrueLeaf. These are some top name companies, and you own them all in a single ticker. So again, if it's something that's interesting to you, but you don't want to take on that single stock risk, then an ETF can provide, some semblance of a way to get exposure. YOLO's overall returns, though, as you can see, there's been a 40-year, 1-year return, 12% year to date, and since inception, about 21%. But, overall, as you can see, it's been a wild ride. And so the growth of 10,000, is pretty much flat since the time of its inception. So right now, while there's a lot of excitement in the space, it's been a little bit of of course, there's a lot of gray area here. So until things really perk up at the federal level, we would expect it to be, a little bit time for consolidation and perhaps for accumulation, but we may not see some real strong strong gains made until we finally get some federal movement. If you look at the expense ratio, it's about 0.75%, and the dividend is around 1%. But when it comes to trading tools on YOLO, you have call and put options, of course, on YOLO, but there's no leveraged ETFs in the space right now with any kind of volume. And you could always use a top 10 holding from YOLO. So in conclusion, what I would say is that the way that I like to approach this is through dollar cost averaging into my chosen investments regularly. So I personally, own QQQ. And so what I will do, and KWEB. And so what I will do is I will dollar cost average into those regularly. And I also want to remind you that the longer that you invest, the lower your overall risk. So if you have a very short time horizon, the risk is pretty high. But if you have a very long time horizon, all things being equal, then you lower your overall risk. You should always expect some down quarters and some down years when you're in pursuit of strong long-term gains. The point is that you shouldn't stop investing. You have to trade that cash that you have now so that you'll have that future purchasing power later on down the road. So don't stop investing. Don't put your money in a jar and bury it in the backyard. Your dollar is not going up in value, it's going down. So you have to find good places to invest. And you can even put it on autopilot with your brokerage account. Now, again, these ETFs are certainly not being recommended to you by myself. I'm not a financial advisor, and I don't know what you should buy. But these are 5 that I think personally could provide a nice long-term potential gain, for those who do their due diligence. And with that said, I guess I'll take some questions, Joe, if there are any.
Yes, there are, Jerry. Thank you for the insights in this great presentation. Just to refresh folks, the 5 ticker symbols, Jerry, correct me if I'm wrong. The first one you mentioned was SPY, SPY. The second one was QQQ. The third one was KWEB. The third one was any of ARK funds, Kathy Wood's ARK funds. And the fifth one was YOLO. Is that correct, Jerry?
That's correct. Mm-hmm.
Terrific. Okay, first question we have for you. Someone's asking, what do you mean by the term trade around? Can you talk about that for a minute or so?
Of course. So let me just use exactly what something that I actually do myself and that I actually teach. So I personally own QQQ, and it's in my long-term investment portfolio. So let's say QQQ goes up by 10% in a given year. Well, that's going to be a given. I'm going to earn the 10% because I owned QQQ in my long-term portfolio. Now, what is so important here is that many people get confused between investing and trading. So I wouldn't be trading my long-term investment. My long-term investment is in my 401k or my IRA, and it's hopefully tax advantaged. And it's what I'm doing is I'm investing for the long term in QQQ. However, I may also have an itch to trade, right? And so I may say, well, I want to trade something. Well, instead of getting on CNBC and looking for something to trade, or for, trying to find, some stock that I could trade, what I could do is I could stay in my own wheelhouse. I already own QQQ. I've already decided that I like this and it fits my risk profile. And I like this particular ETF. So what I could do is, since I already have done my due diligence on the NASDAQ 100, I could then focus my trading, any trading activity that I do, I could focus it around what I already know. And what I was bringing up about the benefits of trading QQQ is the fact that there are leveraged ETFs around it. So I could trade TQQQ if I had the itch to trade, and I could use that and get a 3x return on QQQ. So if I saw, for example, QQQ doing something technically that I said, this could make a good trade, well, then I could buy that. And what it would do is, if I earned 15% on that trade, then what happened to my overall long-term investment? Well, what's happened is I've actually boosted that 10%. I was only going to earn 10% on QQQ, but because I traded around my long-term position, I was able to earn another 15% in a short amount of time. And so ultimately what this does is it boosts my overall ROI on this long-term holding because I'm trading around it. So I hope that makes sense. And you can really do that with SPY. You can do that with many other ETFs as well. And the purpose for this is to streamline what you're researching. Many people just literally trade whatever they see. And as a trading coach, I try to help people focus upon a niche. And many people don't realize how much time they need to spend to effectively trade and to be successful at it. And by focusing upon what you already know, that can empower you and help you earn more.
Terrific. Jerry, thank you. There are other questions, but due to time constraints, we have a next session starting. We're not going to be able to get to those questions, but I would urge everybody to get to Jerry at his phone number is 1-800-609-5530. Again, 800-609-5530, or you can find him at followthemoney.com. Jerry, thank you very much for your tremendous insights. We appreciate you as always. And we want to thank everybody who's joined this session and all the sessions. And again, thank you folks for your feedback, your comments, obviously participating, and keep those comments and feedback coming to us here at Money Show. It makes us better and better as we move forward. But again, get with Jerry directly if you have further questions. He'd be happy to answer them. And again, Jerry, thank you for your time, sir, and these wonderful insights today. Everybody enjoy the next session, and Jerry, and enjoy your day, sir.
Thank you, Joe.
Thank you, buddy. Bye-bye.